Good day, everyone. Welcome to our channel where we bring the world of investing to your fingertips. We're here to simplify the complex, decode the cryptic, and present you with clear, concise information to help you navigate the financial seas. If you're keen on gaining knowledge and wish to stay updated with the latest in the investment sphere, consider subscribing. Today, we delve into the fascinating world of stock market candlestick patterns. Buckle up and let's get started. Before we dive into specific patterns, it's crucial to understand what candlestick patterns are. These are graphical representations of price movements in a specified time period. Each candlestick consists of four main components: the open, close, high, and low. The body of the candle represents the open and close, while the wicks, or lines, show the high and low. Now, these patterns hold significant importance as they illustrate the battle between buyers and sellers in the market, giving us insight into potential future price movements. By correctly interpreting these patterns, investors and traders can make informed decisions about when to buy or sell. It's like having a secret code to unlock the market's next move. But remember, while candlestick patterns offer valuable clues, they are not foolproof. They should be used in conjunction with other tools and strategies for the best results. Now that we've laid the groundwork, let's explore some popular candlestick patterns. First on our list is the bullish engulfing pattern. Now, this is a pattern that gets its name from the way it seems to engulf the previous candlestick. It's a strong indicator that the bulls or buyers are gaining ground in the market. Let's break it down a bit. The bullish engulfing pattern emerges at the end of a downtrend. Picture a day when the bears or sellers have been in control, pushing prices down. This is represented by a small red candlestick. But then, the next day, the bulls step in. They start buying, pushing prices up and forming a larger green candlestick that completely engulfs the previous day's red candlestick. That's your bullish engulfing pattern. But what does this tell us about the market? Well, it's a sign of a potential market reversal. The bulls have wrestled control from the bears, indicating that the sentiment in the market is shifting. Buyers are stepping in, ready to drive prices up. However, it's crucial to remember that while the bullish engulfing pattern is a strong indicator, it's not infallible. Traders often look for confirmation before making any moves. This could be another bullish candle following the engulfing pattern or other technical indicators aligning with the reversal. Moreover, the bullish engulfing pattern is more significant when it occurs on high trading volumes. It suggests that a large number of traders are backing the shift in sentiment, giving it more weight. But as with all trading strategies, there's always an element of risk. Market conditions can change rapidly and without warning. So while the bullish engulfing pattern can be a useful tool in your trading arsenal, it's important to use it in conjunction with other indicators and strategies. In essence, the bullish engulfing pattern is a light in the darkness, a sign that the tide may be about to turn in favor of the bulls. It's a beacon for traders, signaling that it might be time to consider buying. So the bullish engulfing pattern is a strong indicator that buyers are stepping in. Remember, keep your eyes open, stay alert, and let the market's cues guide your trading decisions. Next up is the morning star pattern. This is a fascinating candlestick pattern that can brighten the prospects of your investments. It's a three-candle pattern that signals a potential reversal from a bearish market to a bullish one. Imagine you're witnessing a star-studded night sky. The first candle in this pattern is like a shooting star, streaking across the sky in a long bearish descent. This represents a strong selling pressure, a pessimistic sentiment in the market. Then comes the second candle, which is like a small, twinkling star. It can be either bearish or bullish, but it's always gapped lower than the first candle. This is the indecision phase. The market is uncertain, and it's a tug-of-war between buyers and sellers. Finally, the dawn breaks with the third candle, the morning star itself. This is a bullish candle that opens higher than the second one, indicating that the buyers have wrestled control from the sellers. The market sentiment is changing, optimism is on the rise, and a new uptrend may just be on the horizon. The morning star pattern is a powerful tool in your trading arsenal. It's a beacon of hope in a sea of red, a signal that the tide might be about to turn in your favor. But remember, it's not foolproof. It's just one of many indicators you should use to make informed trading decisions. The morning star pattern is a beacon of hope in a downtrend, signaling the dawn of an uptrend. Now we move on to the doji, hammer, and evening star patterns. We'll kick things off with the doji. This is a unique pattern that appears when the opening and closing prices are practically identical. It's like a tug-of-war, a standoff between the bulls and the bears, with neither side gaining significant ground. The doji is a signal of indecision in the market, a pause in the trend, and it often precedes a potential reversal. Picture it as a crossroads where the market is deciding which direction to take next. Next on our list is the hammer pattern. It's named so because it looks like, well, a hammer. This pattern forms when there's a long lower wick, about 2 or 3 times the length of the real body, and a small upper wick, or none at all. The real body can be either red or green, but the key here is the long lower wick. The hammer signals a bullish reversal, indicating that the price, which was previously falling, might start to rise. Imagine the market as a blacksmith shaping the trend with its hammer. When the hammer hits, it may be time for the bears to retreat. Last but not least, we have the evening star pattern. This one is a little more complex as it's a 3-candle pattern. The first candle is a large green one, signifying a strong upward trend. The second candle, the star, is a small one that gaps above the first. It can be either red or green. The final candle is a red one that opens below the second and closes at least halfway down the first candle. The evening star shines when the bulls are losing control and the bears are ready to take over, signaling a potential bearish reversal. So, there you have it, the doji, the hammer, and the evening star. Each of these patterns tells a story of the market's struggle between the bulls and the bears, the optimism and the pessimism, the buying and the selling. They are the signposts that guide traders and investors in their decision-making. However, it's crucial to remember that these patterns are not crystal balls. They don't predict the future. They merely suggest possible outcomes based on historical data. No pattern, no matter how reliable it seems, can guarantee a particular market movement. They are tools that can help you make more informed decisions, but they are not infallible. So, always conduct your thorough research, consider the bigger picture, and never risk more than you can afford to lose. Trading is as much a game of strategy and patience as it is of knowledge and understanding. Remember, these patterns are indicators, not guarantees. They show potential market reversals. Let's recap what we've learned today. We dove into the intricate world of stock market candlestick patterns, uncovering the signs they signal and the potential market reversals they can indicate. We started with the bullish engulfing pattern, a unique pattern that emerges when a small bearish candle is followed by a larger bullish one, which completely engulfs the prior candle. This pattern often signals an impending bullish trend, a potential sign for investors to consider buying. Next, we explored the morning star pattern, a 3-candle pattern that begins with a long bearish candle, followed by a short candle, and ends with a long bullish candle. This pattern is often seen at the end of a downtrend and signals a potential reversal to a bullish market. Finally, we delved into 3 other significant patterns: the doji, hammer, and evening star. The doji, characterized by its cross or plus sign shape, signals market indecision. The hammer, with its short body and long lower wick, often indicates a potential bullish reversal. And the evening star, a 3-candle pattern mirroring the morning star, suggests a bearish reversal may be on the horizon. Remember, these patterns are tools designed to help you gauge market trends and potential reversals. But they're not foolproof. The stock market is a vast, complex entity, influenced by countless factors both seen and unseen. It's crucial to remember these patterns are indicators, not guarantees. They can provide insights, but they cannot predict with absolute certainty. Investing in the stock market always involves risk. It's essential to approach it with a balanced perspective, using these patterns as part of a broader investment strategy. Stay informed, keep learning, and always be ready to adapt. The market is a complex entity, and while these patterns can provide insights, they're not guarantees. And as always, remember to hit the like button, subscribe, and keep learning. Until next time, happy investing.